David, we got the Fed. How does a grey zone, which you have at the moment got very much at the front and centre of your research notes, fit into that? And what is the grey zone to start off with?
The grey zone is when states exist in a relationship of mutual hostility, but short of war. In other words, you can kill each other's spies, you can put spies in the skies and all that sort of thing. You can cut each other's cables under the ocean, disrupt each other's energy supplies, weaponize the economy, but you do not actually drop nuclear bombs on each other. So the gray zone is a state of hostility before the outright state of war.
Right. David here.
Hello, David.
What does that mean then for asset allocators? Because things are gray. I would imagine they're not black and white or just like in between, I guess. I guess in some ways, is that what's holding back from pulling the trigger?
Yes. I think what asset allocators have to come to terms with is that the confrontation of both I would say dictatorial models and democratic models. So let's say China, Russia on one side as an example, and democracies on the other, is not simply a trade war or a cyclical phenomena or something that will go away. It's going to become deeply embedded, and it will be embedded through alliances. Alliances with China on one hand, alliances with democracies on the other. Now, the interesting thing is that what we found in our research is that those alliances actually trade with each other, use each other's currencies as reserve currencies, and exclude economic intercourse with people outside the alliance. So what that does is it splits the world in multiple parts, not just two, but in multiple parts. And your asset allocation, which previously was based upon globalization, in which everybody was a part of the same football game, is now no longer true. You have risks of being in one match or in one alliance and not in the other. And those risks are highly economic.
So does EM look a little bit different to you now? If China seems to be a little bit more domestic-driven, service-driven, the like here, can these sort of domestic demand stories that we see and idiosyncratic stories that people talk about can offset what we're seeing from the export side of things?
Now, that's a very key question, because there are two things in there. Number one is that China, to achieve growth, can no longer depend on international trade because its products, goods are not accepted and it is not given the technology it needs to grow in that way. What that does is it means that growth in China has to be domestic, which means that it does not come from its surrounding Asian Pacific or indeed Latin American suppliers of raw materials or inputs to that process. Which means that those economies, because they do not have the mass of China, they don't have the alternative of driving their economies with domestic demand. Therefore, they lose out. So essentially what you're seeing there is on a two-faced reaction. You're seeing the effect of gray zone warfare upon two asset categories. And of course, there are many, many, many more.